Noah, I want to get back to your point about there are going to be challenges going forward. You mentioned the DAX in Germany. Could this be a situation where the European economy becomes sluggish and drags the global economy lower, and then we have to start thinking about that spilling over to us here in the U.S. in 2020?
Easily. I think, it's the uncertainty, right, is the problem. Not knowing what's going to happen, not knowing what these other countries will do. It makes companies nervous to spend money there. It's going to make investors nervous to put capital to work there. So I'd like to hope that it wouldn't spill over, within the United States. We have a lot of other things that can affect our markets as well. But certainly uncertainty in the European market for the near term is going to be a big concern from an investing perspective.
It's a worthwhile discussion, Tim, to be thinking 10 years out, is there an EU? So let's say there is no EU. EU-related stocks, do those valuations go higher or lower?
Well, I think when we take a step back and look at what drives the performance of some of the top companies that are domiciled in Europe, particularly in Germany, a lot of that is actually more levered now to emerging market and China growth, some of the incremental new export markets for a lot of those names. So I think even in, let's say, a bear case scenario for the Eurozone, in terms of political union, there's still a lot of opportunity there for companies to continue to grow their earnings through exports. And I think it's more about a story of how does the rest of the global economy do. So as the emerging markets, and particularly China, become more important customers for a lot of these companies, I think there's still a lot of hope there, even in, let's say, a bad outcome from a political standpoint.
Yeah. Tim, we've been talking this week about what would it take for the Fed to cut rates again. Could a slowdown in Europe be enough for them to be proactive here and cut perhaps in the first quarter?
It's possible, certainly. I think when we listen to Jerome Powell's statements and really think about what the Fed would like to do, I think as you get closer and closer to the 2020 elections, there's going to be more reluctance to be seen as sort of having any sort of impact or influence on that. So I think as the year progresses, it's less and less likely that we'll see much action from the Fed. But I think to your point, if there is a big slowdown in global growth or U.S. growth, particularly as a result of that, you could see more action.
No, underneath all these headlines, we've seen some pretty interesting moves sector-wise. Bank stocks have broken out, chip stocks have broken out. What do you like here?
Definitely within the tech space, we're going to be more stock selective there, right? So chip stocks we like. We certainly like media-driven tech companies. We're concerned maybe more about hardware tech companies who do sell overseas and the concerns that they're going to have pushing product out there. So we definitely like certain companies within that tech space. So we're going to continue to like the Facebook, Amazon, Google within the tech space for sure, and see concerns around companies maybe like Cisco Systems as an example.
All right, sticking with the tech space, Jared, you've got a closer look at the Nasdaq right now. What's up?
That's right. The large cap names that we see clustered over to the left, not a lot of movement there. Facebook is down 0.5% after being down significantly yesterday on that headline risk. Some earnings moving stocks here. We have Adobe up 2.9%, and then we have Broadcom down about 4% after that's coming off of a record high here. If we look at the sectors, what's leading today, we can see real estate, energy, and utilities all in the green here, all in leading. A little bit of a defensive setup. We're seeing the 10-year T-note yield come off a few basis points, and that's after yesterday. It was up by the most since President Trump was elected. It was a huge move, and also I should say a huge strengthening in the yuan yesterday. To the downside, staples, industrials, and financials and consumer discretionary are the laggards today, but not a lot of movement so far in the indices.
Tim, should investors just ignore the daily headlines on the trade war, find a good company, invest in it for the next 5 years, and ultimately or hopefully get paid?
We think so. I think when you look at the overlying, the contours of this deal and the particulars around agriculture purchases or tariffs or direction, I think what we try to focus on is not so much the near-term details or even the timing, but to say, look, the movement and the momentum is towards getting something, at least on a phase one, done, whether it's now or shortly. We think there's a lot of good momentum there. So when you're thinking about long-term plays, certainly, it's about picking those names you like and sticking with them. When we think about looking into 2020, given this growth outlook, and we think growth is kind of accelerating back to trend, it's more about the cyclicals versus the defensive names and trying to position yourself in some of those companies. We think on the cyclical side that are going to benefit from, continued, even if it's slow and steady, U.S. growth and global growth.
Noah, what about valuations as you look ahead to 2020? I think the S&P 500 is trading at something like 17.5 or 18 times future earnings. Is this market overbought to you, or are you comfortable with where it's at?
You know, it feels overbought. The comment I mentioned earlier about the Fed and increasing their balance sheet and the liquidity that it provides, right? It pushes prices up, but it doesn't actually improve companies' fundamentals, right? So you think about that dislocation between those two things. So it's very possible that if the Fed, maybe does look at some point early next year lowering interest rates, and they do continue to increase their balance sheet, look for that liquidity to drive prices up, but only to increase those multiples and get you even more concerned that kind of when the music stops, things are going to be a little bit bad. But for now, that liquidity is going to drive prices up, and I think only put even higher multiples on these companies that I think for the longer term isn't just sustainable.
Tim, what are you hearing about trading activity in the first half of January? A lot of people have missed this rally. Theoretically, you could see a lot more people come into the market just because they missed out in 2019.
It's an interesting question because I think one of the things, if we look back really over the last 10 years, has been the total absence of popular interest in the stock market rally. Flows have been incredibly subdued and negative from most sides of the investment equation into stocks. So to say, could we see some renewed interest, akin to what we saw towards the late 90s as even common retail investors started to say, look, I can't miss this rally. You could see some of that. But so far, we've really seen the vast majority of retail investors sitting on the sidelines, even after another 25% up year in the S&P.
That's a lot of gains they have missed. Tim Horsburgh, good to see you. Noah Hamman, always good to see you. And Jared Blikre, we'll see you soon.